Family trusts, how wealthy Canadians can utilize. If you're a high net worth individual or business owner in Canada, and you're thinking about how to preserve your wealth, protect your assets, and pass things down efficiently to the next generation, this video is for you. Welcome to the channel. My name is Anthony Gismondi. I'm a senior wealth advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide them clarity to help them achieve their goals. If you're new to the channel, please make sure to subscribe and click the like button. Today we're talking about family trusts, what they are, how they work, the tax and legal implications, and how you can use them to your advantage, especially if you own a business. Let's get into it. So first, what is a trust? At its core, a trust is a legal relationship where one person, the settlor, transfers property or assets to another person, the trustee, who manages it for the benefit of one or more beneficiaries. Think of it as handing someone a toolbox full of assets with instructions on how to use them for someone else's benefit. Now, there are three key parties. Number one, the settlor, the person who sets up the trust and puts assets into it. Number two, the trustee, the person or institution responsible for managing those assets. And number three, the beneficiaries, the people or entities who will benefit from the trust. Each of these roles has a legal and sometimes tax-sensitive function. And if you're setting up a trust, picking the right trustee is important. It could be a family member, a professional, or even a trust company. Why would you set up a trust? There are several reasons affluent families use trusts. One is control. A trust lets you control how and when assets are distributed. That could mean releasing money gradually over time to help teach financial discipline, or holding it until someone reaches a certain age or milestone. Another is privacy. Unlike a will, which goes through probate and sometimes becomes public record, a trust is private. It can also help produce family conflict. Let's say there's a family cottage that everyone wants to use. Instead of leaving it to one child and hoping for the best, you can place it in a trust and outline exactly how it's to be shared, right down to who pays for the maintenance. Types of trusts in Canada. In Canada, there are two main categories. Number one, they're inter vivos trust. These are set up during your lifetime. They're sometimes called living trusts and are often used in tax planning and asset protection. Number two, the testamentary trusts. These are created in your will and come into effect after you pass away. They're often used to manage inheritances over time or to support minors and dependents. Both have their advantages, and the right one depends on your goals. Advantages of a family trust. First, tax planning. Trusts can help split income with family members in lower tax brackets. For example, if your children are beneficiaries and they're in a lower tax bracket than you, income earned by the trust can be distributed to them and taxed at their lower rates. Second, wealth preservation. Trusts can protect assets from creditors, lawsuits, or even divorce, provided they're set up in advance before any problems arise. Third, succession planning. You can control how your wealth passes to the next generation, especially helpful in blended families or if you own a family business. Fourth, probate savings. In many provinces, property held in a trust doesn't go through probate, which can save time, money, and headaches for your family. But there are drawbacks. It's not all upside. There are a few key considerations. First, tax filing. Trusts are taxed at the highest marginal tax rate if income isn't distributed. So if you're not careful, they can be less efficient than you planned. And yes, they need to file their own T3 tax return every year. Second, record keeping. Trustees have a duty to document their work, keeping minutes of decisions and producing financial statements. Third, and probably most important, the 21-year rule. This rule says that every 21 years, a trust is deemed to have sold all its assets. That means capital gain taxes can apply even if nothing has been sold. So you need a plan for that long-term tax exposure. How business owners use family trusts. All right, if you own a business, listen up. Trust can be a powerful tool for transitioning ownership and minimizing taxes. Let's look at a few examples from real case studies. Case study 1, family trust for a GTA construction company. Let's take the example of a family-owned construction company in the GTA. The business has been run by the Gismondi family for over a few decades, with ownership transitioning from the original founders to their 2 children. The parents, concerned about the future ownership of the company and the tax burden the children might face, decide to set up a family trust. By placing the shares of the construction company into the trust, the Gismondis can control how profits are distributed to their children, who are now running day-to-day operations. The trust allows the parents to split income between family members in lower tax brackets, reducing the overall family tax burden. Additionally, the trust shields the shares from creditors and provides a structured plan for the business to remain with the family for future generations. Few key takeaways. Income splitting. The trust distributes business income to family members who are in lower tax brackets, reducing the overall tax liability. Business succession. The trust ensures that the company remains in the family and continues to operate smoothly after the parents retire or pass away. Asset protection. The trust provides a layer of protection, safeguarding the business shares from potential creditors or legal disputes. Case study 3. A testamentary trust for a manufacturing business in Toronto. A Toronto family owns a manufacturing business that's been passed down through multiple generations. As the current owners near retirement, they want to ensure the business is protected for their grandchildren. To achieve this, they establish a testamentary trust as part of their estate plan. Upon the passing of the current owners, the testamentary trust will hold the restaurant's assets, including the property and shares, and distribute income to the beneficiaries, their grandchildren, over time. This setup allows the family to avoid probate fees, which can be costly, and provides a structured approach to transferring the business assets while minimizing the tax impact on the estate. The testamentary trust also ensures that the grandchildren receive their inheritance gradually, protecting them from receiving a lump sum before they are financially responsible enough to manage it. The trust can stipulate that the beneficiaries receive payments only after they have reached a certain age or met specific conditions, such as completing their education. Here's some key takeaways. Avoiding probate. The testamentary trust allows the family to bypass probate, avoiding delays and high fees. Long-term wealth management. The trust ensures that the grandchildren receive the inheritance in stages, promoting responsible wealth management. Tax savings. By creating a testamentary trust, the family can take advantage of tax planning strategies to reduce the overall tax burden on the estate. Family trusts aren't just for the ultra-wealthy. If you've built a successful business, accumulated assets, or want to protect your family's future, they're worth considering, but they're not simple. You'll need a lawyer, possibly a tax advisor, and a solid strategy to make it work. If you're thinking about setting up a trust, or you're not sure whether it fits your financial plan, talk to a professional who knows your situation. And if you found this helpful, don't forget to like the video, subscribe to the channel, and leave a comment if you've got questions you'd like me to cover in a future video. Thanks for watching, and I'll see you in the next one.